Kia ora, and welcome to the CoreLogic Property Market Update for May 2021. Since the government's bold housing announcement on March 23, all the questions about the market relate to any signs of any early impact. As it stands, the impact so far appears to be relatively limited, with no indication investors are exiting the market, and neither has there been a significant reduction in demand which could lead to values falling. Sales volumes were still pretty strong for April, but there are signs of a slowdown in property values, with the Ryan's House Price Index recording only a 0.6% increase over April, compared to 2.7% in March and 5.2% in February. It's worth noting the index can be a bit volatile month to month, but the numbers back up many of the anecdotes and general gut feel of a slowing but not declining market. So it's potentially still a bit early to read too much into measures of property values. But there are plenty of other market indicators which tell us a lot about market activity. Firstly, we track listings to understand whether the changes are leading to people divesting from the market. New listings coming to market have been seasonally normal, that is generally falling away as we get closer to winter. There are no signs of a mass exodus. So, with persistent strong sales volumes, the total number of properties listed for sale has continued to reduce, meaning we have fewer properties for sale now than at the end of March. Therefore, low supply remains a key market factor. Tracking of real estate agent activity through CoreLogic products, such as Property Guru, shows they remain relatively busy, so upcoming listing numbers should be pretty healthy, but not abnormally high. And, as the total listings counts illustrated, we remain near all-time low levels, so it'll take a while, in conjunction with a significant slowdown in sales, to see supply meaningfully lift. From a demand perspective, there are fewer valuations being ordered through the banks, but part of the drop will be seasonal. And given some of the commentary following the announcement, the drop of 10% compared to the boom period of the prior 6 months is much better than we were led to believe would occur. If we take a look at actual property transactions, we have noted a slight reduction in investor activity in April from earlier in the year, but this likely reflects the reintroduction of the loan-to-value ratio restrictions from March the 1st. Plus, given plenty of uncertainty regarding the tax changes still abounds, many investors may well be biding their time and assessing the market reaction before adding to their portfolio or diving into the unknown for new investors. The recent ANZ announcement that they've reduced the share of rent that is counted towards mortgage serviceability for investors will be another hurdle for them too. Meanwhile, first home buyers have remained active, plenty of whom would have been those who had missed out over the prior 6 months, as the market grew at such a rapid rate, 13.7% to be exact. Speaking of first home buyers, be sure to check out our second edition of the CoreLogic First Home Buyer Report, with an exceptional level of detail about first home buyer activity, including what they're buying, where they're buying, and a first for this report, how old they are now compared to the past. We're expecting the market to moderate, which is good news for prospective buyers. And after a busy start to the year, we also expect the government and Reserve Bank to take a bit of a break from announcing any further changes. The government's main influence will now come via investment announced in the budget. While in the latest financial stability report, the Reserve Bank was clear that any further influence from them would come in the form of tighter LVRs before anything else. Debt to income caps and interest-only limits are essentially off the table for now, as the Reserve Bank plays for time and awaits enough data to measure the impact of the government's tax changes around interest deductibility. This should mean a period of relative predictability over the winter months. Expect to see a reduced number of sales and a reduced rate of value growth. But the chances of values dropping look low for now. Supply is still tight, and the early evidence suggests there remains enough demand for property despite the government's changes. You never know what's around the corner though, so make sure you check out and subscribe to our weekly property market podcast and bookmark the research tab at corelogic.co.nz to keep up to date with the latest news and data and how it all relates to the property market. Mā te wā.